Hi guys!
Hi!
This is Unraveling Systems, and today we're going to talk about banking and the environment. So before everything, let's hear a general explanation on banking.
So banks are financial institutions that lend money to borrowers, thereby creating credit. This credit corresponds to deposits on their balance sheets. Most states have implemented a system which is called fractional reserve banking. Thereby, these liabilities or deposits must be held partially in reserves, so liquid assets or currencies, and partially can be reinvested by the banks.
Nice! So let's look at the different types of banks. First of all, the most common one are retail banks, whereby consumers hold a checkings and a savings account. Then you have commercial banks, which focus on businesses. They also need more complex services. Then you have investment banks, which help businesses within the financial market. They can help them going public or selling their debt. Then you have central banks, which hold and control the monetary policy within a state. An example is the Federal Reserve Bank in the US. Then you have credit unions, which are basically banks owned by the customers. And last but not least, you have online banks, which provides the equal services, except that they are fully online, there's no personal banker, they have no physical establishment. So in order to dive into this link between banking and the environment, we decided to focus on two specific bank types, central and commercial, of which the last includes retail banks and commercial banks.
Let's focus first on central banks. They are entities that supervise the monetary system either of a state or of a group of states, like the European Central Bank. Central banks have different functions, among which the main ones are the first one is acting as a bank of a government. The second one is implementing a number of monetary policies in order to reach goals such as fostering employment or controlling inflation by setting the interest rate, and so on. The third one is issuing currency. The fourth one is supervising commercial banks. And the fifth one is acting as lender of last resort, meaning that if there is no money around, go knocking at the door of your central bank to ask for it. If we want to look more into detail on how central banks act, we could look at two fields. The first one is when they implement policies to foster or save the economy as a whole. They do it by implementing policies that are really important in order to foster economic growth or employment or stabilize prices or put under control inflation. An example is the 2008 financial crisis, when the US Fed and the Central Bank of Europe implemented a number of policies such as quantitative easing. With this term, we mean that they started purchasing government stocks and bonds and other securities in order, on one hand, to lower interest rates and on the other hand, to increase the money supply, thereby flooding financial institutions with credit that they could then lend further. And the final aim was to foster consumption overall within society. The other field we can look into to understand how central banks act is when they implement policies aimed at fostering only one specific sector of the entire economy. And this has happened in the past. For instance, when we look at the US Fed, they implemented a number of policies to channel the credit towards a sector that was considered strategic, that was real estate. But how can central banks act to serve the ecological purpose?
That's an interesting question. What we can say right now is that the low carbon sector is very relevant in order to reduce the impact of climate change. Luckily, we managed to interview an expert, Emanuele Campidio. His research shows that we are currently facing a green investment gap. There's not enough finance and credit flowing to the low carbon sector. His proposal is to introduce green macroprudential regulation by the central bank in order to make money flow into these sectors again. One example of the green macroprudential regulation is green reserve requirements. In order to get a better grasp of this concept, we need to talk about reserve ratio requirements. These are the proportion of a bank's liabilities that they need to hold in reserves. One can differentiate these requirements by looking at the specific sectors a bank lends its money to. In the case of green reserve requirements, a bank that lends its money to the green or low carbon sector would be given a lower requirement. This would thus incentivize banks to lend more money to the low carbon sector and thus make us more resilient to climate change. Another example of green macroprudential regulation is green quantitative easing. Chiara already explained the basic of quantitative easing. In the case of green quantitative easing, the central bank buys green bonds. The funds from this purchase will be used to finance low carbon projects. Economists who are in favor of this approach believe that it's less exposed to the risk of speculative bubbles compared to conventional quantitative easing.
And let's look now at commercial banks. They can accept deposits, they can offer business loans, and they can also offer other basic financial services. But we are more interested in looking at the way they create money, and for this we have prepared a nice animation.
Enjoy it! Approximately 97% of all the money in circulation right now is created by commercial banks. The rest is actually printed by central banks. This creation of money happens every time an individual or business takes out a loan at a bank. In order to explain how this works, let's look at a simple hypothetical situation. This is John. John really wants to buy a car. The car costs $80,000, but John does not have that much money. He decides to ask his bank to help him out. The bank agrees to give John a loan of $60,000. John can now buy a new car by paying a fixed monthly fee, including interest over the next 5 years. But where does the credit that the bank gave to John come from? Most people assume that that credit comes from David, a high-income business owner with $1 million in his saving account. The bank could simply lend this money to John and put it back in David's account as soon as John is done paying. However, this is not what happens. Let's take a look at this process from a more technical point of view, by looking at the balance sheet of both the bank and John before and after the loan. Let's assume that this is the first loan John takes in his life. On his balance sheet, we can see assets and liabilities. His assets consist of deposits he has at the bank and the hard cash he has in his pockets. Since he does not have any loans, he does not have any liabilities. When looking at the bank, we can see its assets, defined by the hard currency it owns, and its reserves. Its liabilities are defined by all of the money its customers have trusted the bank to store. Now, after the loan is made, we can see that John's assets increase, since the bank has written a check or put money on his account, and that his liabilities increase as well, since this money has to be paid back to the bank. Similarly, the bank's balance sheet is affected on both the asset side, since it expects John to pay back the money, and on the liability side, since John's new money is currently deposited on his own account at the bank. In the end, the point is that in creating the loan for John, the bank does not use either its assets in the form of its reserves or its liabilities in the form of David's saving account. It just makes money appear. Okay, so that animation showed how money is created. Interesting, right? But what does it mean for climate change, the environment, and ecosystems? We decided to interview our expert, Luc de Waal-Malefeits, to explain this connection, and you can see his contribution in our next video.
So, we have looked into central banking, into commercial banking, and the last part of this video is going to be dedicated to debt, both in finance and in banking, and how it is related to environmental degradation. What is debt though? Debt is an amount of money that is borrowed by one party to another, and usually as an instrument allows an enterprise or an individual to make a big purchase that he or she could not have afford under normal circumstances. But do you remember stock and bonds in video 1? Well, this amount of money that is borrowed has to be usually paid back at a later date, usually with interest rate. Let's not forget that.
You can distinguish two types of debt, on a state level and on a household level. So when it comes to the state debt, remember the case of Zambia in video 1. Usually people think that environmental issues and debt are not related. Well, on the contrary, we have seen that in order for developing countries to repay their debt, they really go into milking the earth's resources because they can gain a large profit from this. Usually they cut back on other services and programs dedicated to healthcare, environment, education, etc. But also developed countries are facing this problem, especially since the 2008 financial crisis. They have implemented austerity programs and measures to boost the economy, but at the same time cutting back on the basic programs I just mentioned. Then we have debt on a household level. Household debt is defined as the amount of money an adult in a household owes to financial institutions, and it can be categorized in several ways. For example, through a mortgage, the car loan you have, a student loan, and even credit cards.
But to explore better how a household debt impacts on the ecosystems, the environment overall, we managed to get in touch with another expert, which is Justin Ricci, that sent us his contribution. So I think that for this introductive video we're done. Check the next videos, one from Luke and the other one from Justin. And
that's it for today, guys.
ciao!
Bye bye!